Right, let's get your thoughts on what to expect overall. Q1 numbers, there were a few surprises. I remember the likes of Diamond Bank and UBA were negative surprises. But what should we expect? What are the main things that you think will come out of the Q2 numbers?
Good. I say Q2 numbers are going to be very affirmative of the recovery that we saw in Q1. Precisely, we are upbeat on three key heads, particularly the revenue generation of those banks. Don't forget that one of the drag that we saw in Q1 is the fact that yields were very low, and that was because of the relaxed monetary environment. Now, after the tightening that we saw in the first quarter of the year, you will notice that yields actually improved significantly, and these banks are liquid. So it gives them an opportunity to actually reprice their assets, because these are banks that actually have a liquidity of around 50%. In terms of cost, I think one interesting thing is that over the last 2 quarters, banks have been able to scale down their cost. You're beginning to see them putting more efficiency in terms of their operation. And the major rationale for that is that they've seen that if you cannot grow your revenue as much as you want, then what you have to do is to actually scale down your cost. So that at the end of the day, your cost-to-income ratio looks attractive and you make a good operating profit, which was what we saw in Q1. You notice that the top line of most banks in Q1 were actually down relative to 2010, but in terms of the operating income, they were actually up, and that was a key attraction. For Q2 numbers, I would say that we don't expect so much of growth in terms of the top line, but we expect that the bottom line will grow significantly. And the major rationale for that is the fact that when you have an increasing revenue base and you then have a lower cost, what you have is a higher bottom line. And don't forget that the major drag on earnings over the last 4 quarters, which is basically provisions charge in P&L, is actually easing now. From a cost of risk of around 2% in 2009, we've seen it scale down to around 0.2, 0.3 by Q1. No. And going forward, because of the improvement in asset quality, we're likely to see lower cost of risk, which definitely will enliven the bottom line.
Very important point you've raised about the provisions, because obviously, like you mentioned, it's a drag, and it's been a drag for really more like 2 years now. AMCON has come to the table to rescue this bank somewhat. What will be the impact of AMCON's activity? Obviously, many of the banks participated in the swap for loans for bonds with AMCON in Q1. We'll probably see the impact of that in Q2. What should we expect generally from that transaction?
On a broad perspective, I would say that AMCON deal Q2 is going to be more positive than what we saw in Q1. In Q1, you appreciate that most of the banks actually recorded loss on the sale of their NPLs to AMCON. And that was because of the valuation of AMCON. At the same time, it was actually informed by the lower coverage ratio that they had in 2010 December. And you know, when you look at the effect, the P&L effect of AMCON deal is largely a function of what the provisions level for those toxic assets are, and at the same time, what is the valuation of AMCON? For Q2 AMCON deal, we expect that apart from the fact that it's going to strengthen their balance sheet, because you are taking out toxic assets and you are giving liquid asset to these banks, which will improve their liquidity and the overall strength and of the balance sheet and health of the balance sheet. What we'll see in terms of Q2 numbers for AMCON deal is that we're going to see positive write-backs, particularly for banks that have a good provisions level. And I'll give you an instance. GT Bank, for instance, has a provisions coverage of around 100% as a Q1. So by the time we see the AMCON deal, in Q2, they sold some 25 billion naira toxic asset to AMCON, and we expect that from the sale of that NPL, they're likely to see some 4.5 to 5 billion naira write-back. The same thing might go for the likes of FCMB, which has a coverage of around 100%. We may see the same thing playing out for Skybank. But why you won't really see it on the face of the numbers is because of the fact that they're going to make 1% general provision this year.
Right.
So what we'll see is that it's going to be more of a cushion for that 1% general provisions that they're going to make this year. And that's why for what's it called, GT Bank, for instance, that would have made maybe some provisions of around 7 billion naira in terms of the general provisions, 1% general provisions, which is a provincial guideline. What you see is that there may be a provisions of around 3.5 billion naira based on our own estimate by the end of the year, just because of the buffer that we are seeing from the effect of the AMCON deal. And for us, we're more positive on the second tranche of a AMCON deal.
All right, but very quickly, if you can just give me your thoughts. Will the numbers be a catalyst for the sector? Because like I mentioned, they're down 17%. They've been a huge drag on the NSE this year. What are your expectations?
Yeah, as for expectations with respect to the stock prices, we don't expect so much of a strong rally on the back of those numbers. And the major reason for that is because of the macro environment. Because when you look at earnings, it's concerned with the drag that we're seeing now, both from the global scene and the domestic macro environment this time around. And one of the key things that we see is that Q3 numbers will be the major catalyst for stock prices. But notwithstanding, Q2 numbers are going to be good, like I said. It's going to affirm the recovery that we saw over the last 2-3 quarters. And definitely we will see some mild rally for banking counters.
So
and
in worst case, it will provide some support.
Definitely to provide support, and that will definitely lift the markets.
Let's talk a bit about the macro picture, like you just pointed out. And, there's just this sense that I get from many, particularly investors, that the banking sector is still under some pressure. Yes, we've had 2 years of struggle, so to speak, and we're about to turn the corner now. The big question is, what type of growth should we expect going forward? There's been a lot going on behind the scenes about pushing growth to the real sector. It seems that's the main play for banks going forward, because when you look at their participation in that space, it's pretty low right now, isn't it?
Yeah. You see, before now, we have actually been conservative on the reforms that CBN is doing with respect to pushing loans to the real sector of the economy. But I think over the last 2 quarters, we've been upbeat on the steps that have been taken by CBN. Because now you're looking at involving the likes of UNIDO, you're bringing World Bank into play, you're bringing AGRA into play.
And they are providing?
They are providing support, which is more of guarantees.
Right.
And you see, the major rationale for our own upbeat on that strategy going forward is the fact that when you give guarantee on the loans that are going to be given to this real sector of the economy, particularly the agricultural sector of the economy, which contributes some 40% of the GDP. The major thing that you see is that banks will have the opportunity of learning that those sectors are actually profitable and you can actually lend to them. Now, once the guarantee is there, it gives those banks that opportunity to actually explore the opportunity that you see in those markets, because it minimizes the exposure at default. So that in case those loans go bad, the exposure they have at default is actually minimal, and that will give them room to actually fine-tune their framework and to also learn that those sectors are actually profitable. And once the guarantees is then removed, maybe over the next 2 years, we might not see the guarantee there again. Banks will have been able to build their own capacity with respect to lending to the real sector of the economy, particularly the agricultural sector, which for me is going to be the major gameplay going forward. Oil and gas sector is still there, it's opening up further. We'll see the power sector coming into play. Don't forget, World Bank is actually giving guarantee, and the commercial banks, of course, have a key role to play, because we're talking of a capital-intensive sector of the economy.
So put all that in context for us. What type of growth rates are you expecting for the sector in terms of loans? We know this year is going to be pretty slow, but going forward, what should we expect?
For this year, we're expecting maybe 10 to 15% growth in private sector credit. It was just about 2% up as at May provisional data. But we still expect that going forward, maybe 2012, we'll see some 20% growth in that sector. And I'll give you an instance. Access Bank, for instance, over the last 3 quarters, I've been able to grow the agricultural lending from 0 to 6 billion naira portfolio. Now, you won't see the effect of that on a growth basis. You might not see the effect of that on the books of Access Bank, just because of the fact that 6 billion naira is still pretty small relative to the overall size of the loan book. But when you then look at that strategy going forward, it gives you an opportunity to actually see that there is significant opportunity in that sector of the economy, particularly when you see guarantees come into play. Because these banks now, it minimizes their risk exposure. And one key thing is that the way the guarantees are framed, I think it reduces the moral hazard of banks, because one of the downside of guarantees is that you might see moral hazard and adverse selection with respect to banks' exuberances. But I don't think we'll see that going forward for banks because of the nature of the framework.